So on a normal Tuesday, let's just say a company that manufactures tractors goes bankrupt.
Right, a localized event.
Yeah, exactly. It's a localized tragedy. The employees lose their jobs, the shareholders lose their shirts, and, maybe the town where the factory is located suffers a severe economic downturn.
Sure.
But the wider global economy, it basically barely registers the event.
It doesn't care.
Right. But now imagine a major global bank fails on that exact same Tuesday.
Oh, totally different story.
Completely different. By Thursday, global supply chains freeze up. The ATM down the street just stops dispensing cash. And that healthy tractor company, completely unrelated to the bank, suddenly cannot make payroll because their line of credit vanished overnight.
Yeah, the money's just gone.
It's terrifying. So today, we are opening up a massive stack of notes covering CFA Level 2 Reading 11. Our mission in this deep dive is to basically decode the incredibly secretive, highly regulated world of financial institutions, specifically banks and insurance companies.
Which is a beast of a topic.
It really is.
Yeah.
Because we're basically going to learn how to be the financial health inspectors for the institutions that hold literally everyone's money.
And that contagion effect, you mentioned that, is the perfect place to start. Because it really dictates everything about how we analyze these entities,
How so?
Well, the tools a financial analyst uses to evaluate, like a retail company or a big tech giant, they are fundamentally useless when applied to a bank or an insurer.
Just completely different metrics.
Completely, because they are the plumbing of the entire economy. And, a clog in one pipe can flood the entire house.
Yeah, that makes sense.
Yeah.
Now, because we know you, listening to this deep dive, already understand the basics of a balance sheet, we aren't going to spend time explaining what a liability actually is.
Right, we're past that.
Exactly. But we do need to completely reframe how we look at those components. With our hypothetical tractor company, the assets are tangible, right? It's the factory, the stamped steel, the unsold tractors sitting on a lot.
You can walk up and touch them.
Right. But a bank's balance sheet is entirely inverted. It's almost like an anti-gravity room where up is down. Your cash deposit, your money, is actually a liability pulling the bank down.
Because they owe it back to you.
Yes. And the debts of total strangers are the assets keeping the bank afloat. So the entire job of an analyst shifts from evaluating what a company physically produces to how successful management handles the incredible friction between those two sides.
And that friction, it's exacerbated by how those assets are valued.
Which is the tricky part.
Oh, it's wild. Like, a tractor factory is usually reported at its historical depreciated cost, right? It is a slow, very stable number. But a bank's assets are primarily financial. They're just paper promises, like loans and securities.
Right.
And under accounting rules, a lot of these financial assets must be reported at fair value.
Which introduces massive volatility.
Massive.
Because if the value of those paper promises fluctuates wildly every single day based on current market conditions or interest rates or, just global panic.
Yeah, the actual net worth of the bank is just a constantly moving target.
And honestly, that sounds like a terrifying foundation for an entity that is supposed to be the absolute bedrock of the global economy.
It really is.
Like right off the bat, that tells me we can't just trust these institutions to self-regulate. The temptation to mask that volatility, to smooth things out, must be overwhelming. So we need global referees.
We do. Which brings up a really fascinating structural reality of the global financial system. The primary referee isn't actually a global government.
Wait, really?
No, there's no monolithic financial police force. The most important architect of financial stability is the Basel Committee on Banking Supervision.
Okay, the Basel Committee.
Right. They provide what we call the Basel III framework.
Okay, the notes mention Basel III extensively. But I really want to push back on how it actually functions in the real world, because is it a binding international law?
No, it's not.
So if it's just a set of suggestions, why would a highly competitive, profit-hungry bank ever voluntarily hold more capital than they strictly have to? I mean, capital sitting there isn't making money.
That is a crucial distinction. The Basel Committee has zero legislative authority. None.
Wow.
Yeah, Basel III is just a regulatory framework. It's a set of highly complex, internationally agreed upon standards, but it works through basically macroeconomic peer pressure.
Peer pressure.
Literally. Individual countries and their central banks voluntarily adopt the Basel III standards, and then they write them into their own binding national laws.
So it's essentially a massive global trust exercise.
Exactly.
If a country decides to just ignore Basel III and lets its domestic banks operate like the Wild West, with zero capital requirements, other countries simply won't allow their banks to do business with them.
Right, you are exiled from the global financial sandbox.
That's wild. So that is the actual enforcement mechanism.
Yeah. To maintain access to international markets, a nation has to ensure its domestic banks are trusted. And Basel III builds that trust upon three main pillars, which are designed to act as shock absorbers for the global economy.
And those are?
Minimum capital requirements, minimum liquidity thresholds, and stable funding profiles.
Okay, before we dig into the actual mechanics of how analysts score those pillars, because I know that's a massive topic on its own, the notes also highlight a few other acronyms in this regulatory alphabet soup.
Oh, yeah, there are a lot of them.
We have the Financial Stability Board, or FSB. We have IOSCO and the IAIS. How do they fit into the hierarchy if Basel III is, the gold standard?
Think of them as specialized task forces. The FSB is the overarching coordinator. They look at macro-level vulnerabilities across the entire global financial system.
Like bird's eye view.
Exactly. Coordinating between national authorities and standard-setting bodies just to prevent the next global crisis. Then you have IOSCO, the International Organization of Securities Commissions.
That's their focus.
They focus purely on the markets themselves. They strive to ensure fair, efficient, and transparent securities markets, basically protecting the investors trading within them.
Got it. And the IAIS, the International Association of Insurance Supervisors, I'm guessing they do the exact same thing, but for the insurance sector.
You nailed it.
Okay, so if these bodies are setting the rules of the game and establishing the boundaries of the playing field, how does an analyst actually keep score?
That is where we get into the frameworks.
Right. We know from the source material that for banking, the ultimate scorecard is the CAMELS framework, CAMELS.
Such a classic finance acronym.
It really is. It stands for capital adequacy, asset quality, management capabilities, earnings quality, liquidity, and sensitivity. Let's tackle the foundation first, right? Capital adequacy and asset quality.
Yeah, so capital adequacy is the bank's ultimate line of defense. The entire point of a bank holding capital, meaning its own equity, is to absorb business losses without going bankrupt and taking the depositor's money down with it.
That makes sense.
However, Basel III doesn't use some simplistic formula like demanding a bank hold 10% of its total assets in cash.
Why not?
Because that would be wildly inefficient. It would totally choke off lending to the real economy. So instead, it relies on a highly sophisticated system called risk-weighted assets, or RWAs.
Okay, let me see if I can translate the logic of risk-weighted assets.
Yeah.
Because it sounds like evaluating the people you lend money to based on their personal track record.
Go for it.
Like, if I lend $50 to my incredibly responsible sister, the risk of her not paying me back is basically zero. I don't need to keep extra cash in my own wallet just in case she defaults.
Right. She's a safe bet.
But if I lend $50 to my notoriously unreliable cousin who is always looking for his next big scheme, the risk is massive.
Oh, yeah.
So I need to hold on to a reserve of my own cash to ensure I can still pay my rent when he inevitably defaults.
That captures the underlying mechanics perfectly. Not all assets on a bank's balance sheet carry the same probability of default. So if a bank holds cash or deposits directly with a central bank, the assigned risk weight is 0%. There is functionally zero risk of loss.
So the bank doesn't need to hold capital against that specific asset.
Exactly. But according to the source data, a standard performing corporate loan carries a 100% risk weight.
Oh, wow.
And a consumer real estate loan might carry a 50% or 90% risk weight, depending on the specifics of the loan.
Okay, so the math actively forces the bank to recognize the danger of its own portfolio. Like if a bank has $1 billion in pure cash and $1 billion tied up in corporate loans, their total assets are $2 billion.
Right.
But for regulatory purposes, their risk-weighted assets are only $1 billion because the cash contributes zero to the risk profile.
You've got it. Furthermore, if that corporate borrower misses a payment and the loan becomes non-performing, the risk weight doesn't stay at 100%.
It goes up.
It jumps. It goes to 150 or even 200%.
Oh, wow.
Yeah, so the bank's total risk-weighted assets inflate instantly, which forces them to hold even more capital just to maintain their regulatory minimums.
That completely explains the denominator of the equation. Now let's look at the numerator, the actual capital the bank holds. The notes detail how Basel III breaks capital down into tiers. based on its quality and its ability to absorb losses.
And quality is the operative word here, because in a crisis, not all capital acts as a reliable cushion.
Right.
The absolute highest quality is Common Equity Tier 1, universally known as CET1.
CET1.
This consists of the bank's common stock, additional paid-in capital, and retained earnings. This is the bank's own permanent money.
So no one can ask for it back tomorrow.
Exactly. It has no maturity date, and the bank is under no legal obligation to pay dividends on it. So if the bank takes a massive loss on a bad loan, that loss is subtracted directly from CET1, shielding the depositors entirely.
And Basel III sets a hard floor here, right?
Yeah.
The minimum CET1 ratio must be 4.5% of the bank's risk-weighted assets.
Yes. 4.5% is the absolute floor. From there, you build upwards. Total Tier 1 capital includes that CET1, plus certain other instruments like specific types of subordinated debt that lack a specific maturity date. The minimum for total Tier 1 is 6% of RWAs.
Okay, 6%.
Finally, you have total capital, which adds in Tier 2 elements. That's things like subordinated debt with an original maturity of more than 5 years. The absolute floor for total capital is 8% of risk-weighted assets.
Okay, so to put some real-world context to these percentages, the notes provide a great example from JP Morgan Chase's 2017 annual report. Their CET1 ratio was reported at 12.2%.
Which is huge.
Yeah, if the regulatory floor is 4.5% and JP Morgan is operating at 12.2%, that tells an analyst they have an absolutely massive cushion against catastrophic losses.
Yeah.
Like they were holding nearly 3 times the required high-quality capital.
They are very well capitalized in that example.
But, and here's the catch, a massive capital cushion is entirely useless if the assets themselves are rotting from the inside out.
Absolutely.
Which brings us to the A in CAMEL's asset quality. We established earlier that a bank's assets are primarily financial and marked to fair value. But how does an analyst actually verify that value? I mean, I can look up the price of a publicly traded stock in 2 seconds on my phone,
Right.
but I can't look up the price of a highly customized corporate derivative contract.
And you've just hit on the most dangerous area of bank analysis.
Oh, really?
Oh, yeah. To manage this transparency issue, financial reporting utilizes the fair value hierarchy. It categorizes assets into level 1, level 2, and level 3 inputs based on exactly how their value is derived.
Okay, walk me through those levels.
So level 1 is exactly what you just described. These are quoted market prices for identical securities in an active, highly liquid market.
Like stocks.
Like stocks. If a bank owns shares of a major publicly traded company or, standard U.S. Treasury bonds, the valuation is totally objective and verifiable by anyone.
Which gives an analyst total confidence in that portion of the balance sheet. But the notes say, level 2 inputs involve, and I'm quoting here, observable inputs for things that don't trade actively. That sounds like a bit of a slippery slope. How much guesswork is an analyst actually allowing here?
Well, it allows for calculation, but not pure imagination.
Oh, yeah?
A level 2 asset might be a corporate bond that trades infrequently. Because there is no identical active market price today, the bank uses the price of a highly similar bond that did trade today. Or they derive a value based on publicly observable interest rate curves.
So the ingredients are public.
Exactly. The ingredients of the valuation model are public. An external auditor or an analyst can take the exact same public data, run the math themselves, and verify if the bank's valuation is accurate.
Okay, that makes sense. Which leaves us with level 3.
Level 3.
The notes describe these as unobservable inputs based on management's assumptions and internal models. That doesn't sound like a slippery slope. That sounds like a cliff.
It is a cliff.
If a bank holds complex, bespoke financial instruments where there is no active market, are they basically just grading their own homework?
Yes. It is often referred to by skeptics as mark to model or even mark to myth.
Mark to myth. Wow.
Yeah, because if a bank holds a highly customized derivative contract, they might literally be the only institution in the world that knows the specific terms. They input their own proprietary assumptions about future default rates, correlation risks, discount rates, all into this black box mathematical model.
And the model just spits out a number.
The model spits out a value of, say, $100 million, and you just kind of have to trust them.
But what happens when the broader market suddenly disagrees with the bank's internal model? We saw this exact scenario play out during the 2008 financial crisis, didn't we?
It was the catalyst for the entire meltdown.
Yeah.
Banks were holding billions of dollars in toxic mortgage-backed securities. When the housing market cracked, the market for those securities completely froze. There were zero buyers.
Right.
Suddenly, assets that were considered level 2 became level 3 overnight because there was no observable market data left.
Oh, that's terrifying.
The bank's internal models insisted these assets were still incredibly valuable. But when they were forced to actually sell them to raise cash, the real-world prices were literally pennies on the dollar. The models failed catastrophically, wiping out the bank's capital cushions in a matter of days.
That is wild. The JP Morgan 2017 example in the text notes that level 3 assets represented 3.2% of their total fair value assets.
Right.
And, in isolation, 3.2% sounds like a rounding error. But when you are dealing with a balance sheet in the trillions of dollars, 3.2% represents tens of billions of dollars tied up in assets where the valuation relies heavily on the bank's own internal optimism.
Exactly. Now imagine if an analyst looked at a different bank and saw that 20% of their assets were classified as level 3.
I would panic.
You should. The reported capital cushion suddenly looks incredibly fragile. You have to aggressively discount the reliability of their entire equity position.
Absolutely. Okay, so we've established that a bank can manufacture a beautiful capital cushion on paper using level 1 and 2 assets, and maybe obscure some real risks in level 3. But paper buffers mean absolutely nothing if the people steering the ship are incentivized to crash it into an iceberg.
Very true.
How do analysts quantify human greed and competence? That brings us to the M&E of camels: management capabilities and earnings quality.
So, evaluating management in a financial institution is fundamentally an exercise in assessing risk governance.
Well,
Like in a tech company, you might evaluate management on their visionary product roadmap, right? Or their ability to capture market share. But in a bank, management's primary directive is identifying, measuring, and controlling risk, credit risk, market risk, operating risk, and legal risks.
But an external analyst can't sit in the boardroom. They can't listen in on the internal risk committee meetings. How do you measure the effectiveness of management from the outside?
You look for the structural outputs of their culture,
Yeah.
and the single most important indicator is the true independence of the board of directors. Yes. The board's fundamental job is to set the ultimate risk appetite for the institution and to act as a counterweight to executive management.
Give me an example of why that matters so much.
Okay. Consider the incentive structures at play. A senior trader or an executive might be heavily incentivized by a year-end bonus tied to sheer revenue generation.
Right, they want that payout.
They have a massive personal incentive to take on extreme, highly leveraged risks to secure a multi-million-dollar payout in December, knowing full well that if those risky bets blow up 3 years later,
They don't care.
they don't care if they have already cashed the check and left the firm.
That is the classic principal-agent problem operating on financial leverage steroids.
Yeah.
The agent, the manager, takes all the upside, while the principal, the shareholder, eats the catastrophic downside.
Exactly. So an effective, independent board implements strict internal controls to stop that behavior. They establish hard limits on value at risk for trading desks. They implement clawback provisions for executive compensation. And they ensure the internal audit function reports directly to the board, not to the CEO.
Oh, that reporting line is huge.
Huge. As an analyst, you look at the proxy statements and governance reports to see if these control mechanisms are actually functioning or if they are just, window dressing.
A key byproduct of excellent management is the E in our framework: earnings quality. We tend to just think a dollar of profit is a dollar of profit. But the notes make a very clear distinction between sustainable earnings and volatile earnings.
They really do.
Let's contrast two hypothetical institutions to explore this. Let's say Bank A is a traditional, perhaps slightly boring operation. The vast majority of its profit comes from net interest income, the spread between what they pay depositors and what they charge on traditional mortgages and corporate loans.
Very standard.
They also generate steady fee income from wealth management and transaction processing. But then you have Bank B. Bank B derives a massive portion of its profit from its proprietary trading desk, aggressively speculating on currency swings, interest rate derivatives, volatile equities. In a bull market, Bank B might post raw earnings that absolutely crush Bank A.
They probably would. But an analyst will assign a much higher valuation multiple to Bank A.
Why is that?
Because net interest income and fee-based service income represent high earnings quality. They are recurring, highly predictable, and sustainable across different economic cycles.
Whereas the trading income.
Trading income is the exact opposite. It is highly volatile and totally unpredictable. The trading desk that generated record profits in a bull market can easily generate record-setting, capital-destroying losses the moment the market turns.
Right.
Therefore, Bank A has superior earnings quality, even if Bank B occasionally wins the raw revenue race.
The text also points out a much more insidious threat to earnings quality: accounting manipulation.
Oh, this is a big one.
We talked about the dangers of mark-to-model with level 3 assets, but the notes specifically highlight the allowance for loan losses.
Yes.
Like, if a bank issues 1,000 mortgages, statistical probability dictates that a certain percentage of those homeowners will eventually default. The bank is required to estimate those future losses today and set aside a reserve out of their current earnings. But because it is an estimate, it is completely ripe for manipulation.
It is one of the most common ways bank management engages in earnings smoothing.
How does that work?
Well, if a bank is having a phenomenally profitable year, management might decide to artificially inflate their estimate for future loan losses.
Wait, why would they want to lower their own earnings?
To save it for a rainy day, they take a bigger expense today, which lowers their current stellar earnings, and they stash that extra money in the reserve. They're essentially creating a cookie jar.
A cookie jar. And when the inevitable recession hits a few years later and actual earnings plummet, they reach into that cookie jar.
Exactly. They lower the estimated provision for that year, drawing down the bloated reserve to artificially boost their reported earnings during the downturn.
That is so sneaky.
It really is. While this makes the bank appear incredibly stable to a casual observer, it completely obscures the true economic reality of their loan portfolio.
Right.
An analyst evaluating earnings quality must aggressively scrutinize these discretionary accruals to determine if management is reporting reality or just painting a pretty picture.
Which leads us to a pretty chilling realization. A bank can have a fantastic capital cushion on paper, robust risk management controls,
Right.
high-quality, sustainable earnings, and still completely collapse in a matter of hours.
Yes, it happens.
A profitable bank can die in a single day if it runs out of cash. This brings us to the L and the S of camels, which are perhaps the most critical metrics in the modern era: liquidity and sensitivity.
Liquidity is the oxygen of the financial system. It really doesn't matter how many billions of dollars in long-term assets a Wayne holds if they cannot meet their immediate short-term obligations.
Right.
If depositors lose confidence, show up at the branch, and demand their money, and the bank doesn't have the cash in the vault to hand over, the bank is functionally insolvent, that is a classic bank run.
And to prevent that scenario, Basel III introduced two highly specific liquidity metrics. The first one is designed to measure survival in an acute crisis: the liquidity coverage ratio, or LCR.
Yes, the LCR.
The formula for LCR is highly liquid assets divided by expected cash outflows in a stress scenario. Let's break down the mechanics here. What exactly qualifies as a highly liquid asset in the eyes of regulators?
These are assets that can be converted to cash almost instantly with little to no loss of value, even during a severe market panic.
So cash.
The purest form is physical cash and reserves held directly at the central bank. Next would be high-quality government securities like U.S. Treasuries because they have an incredibly deep, active secondary market.
Okay.
Regulators strictly define what qualifies as high-quality liquid assets, or HQLA, to prevent banks from padding the numerator with assets that might freeze up during a crisis.
The denominator is the really fascinating part to me. Expected cash outflows in a stress scenario. Because regulators don't just ask what the normal daily withdrawals look like.
Yeah, they assume the worst.
They apply a standardized 30-day panic scenario. They assume a significant percentage of retail deposits will just flee, wholesale funding lines will be cut off, and corporate clients will draw down their credit lines simultaneously.
It's a true doomsday test. And Basel III mandates that the LCR must be at least 100%.
Meaning, the bank must have enough pure liquidity on hand today to survive a brutal 30-day hemorrhage of cash without needing external life support.
Precisely. Now, while the LCR protects against a sudden heart attack, the second metric looks at the long-term metabolic health of the bank's funding. This is the net stable funding ratio, or NSFR.
Okay, NSF.
The NSFR operates on a one-year time horizon. It is designed to ensure that a bank's long-term illiquid assets, like a 30-year mortgage, are funded by reliable, structurally stable sources of liabilities. The formula is available stable funding divided by required stable funding. And again, the regulatory minimum is 100%.
The concept of available stable funding really highlights that not all deposits are created equal, right?
Absolutely not.
Like, if I have $10,000 in my retail checking account, regulatory history shows that I am highly unlikely to move it. Unless there is front-page panic, retail customers suffer from intense inertia.
We are very lazy with our bank accounts.
Exactly. Therefore, Basel III assigns a very high stability factor to retail deposits. But what constitutes unstable or hot funding?
Unstable funding typically comes from the wholesale market. If a bank relies heavily on short-term loans from other financial institutions, large corporate deposits, or commercial paper to fund its operations, it is in a very precarious position.
Why is that so dangerous?
Because those institutional investors are highly sophisticated and entirely ruthless. At the very first rumor of trouble, they will not roll over their short-term loans. That funding can evaporate literally overnight.
So it's hot money because it burns you if you hold it too long.
Exactly. The NSFR penalizes banks that rely too heavily on this hot money to fund long-term assets.
The notes actually provide a data table with 4 hypothetical banks to illustrate how these two metrics interact, and it reveals a massive analytical trap.
It's a great example.
If you look at Bank Charlie, they have an LCR of 108% and an NSFR of 132%. Then you look at Bank Delta. They have an LCR of 111%, but an NSFR of only 89%.
Right.
If an analyst only looked at the short-term LCR, Bank Delta actually looks slightly safer than Bank Charlie. They have a slightly larger buffer for a 30-day panic.
On the surface, yes.
But if you look at the underlying structural health, the NSFR, the narrative completely flips.
It reveals exactly how they have chosen to structure their entire business. Bank Charlie is built for a marathon. With an NSFR of 132%, their long-term assets are overwhelmingly funded by sticky, highly reliable retail deposits or long-term debt.
But they are running lean on cash.
Right. They are running somewhat lean on their immediate cash buffer, barely clearing that 100% LCR hurdle. So they would survive a long winter, but a sudden violent shock could be a close call.
And Bank Delta.
Bank Delta is the real problem child. Their NSFR of 89% violates the Basel III minimums. They are built for a sprint. They have enough cash to survive a month, but structurally, they are heavily dependent on rolling over short-term, unstable funding to maintain their long-term loan portfolio.
This brings us to a concept that explains why banks like Delta take that structural risk in the first place. Maturity mismatch.
Yes.
To me, maturity mismatch sounds like someone trying to buy a house with a 30-year mortgage, but choosing to pay for it using a never-ending series of 30-day payday loans.
That is a terrifying image.
Right. The spread might be fantastic. Maybe the payday loans are charging 1% this month while the mortgage is yielding 5%. You are making a brilliant profit on the spread. But the fatal flaw is that you have to successfully renew that payday loan every single month for 30 years. If the payday loan market freezes up for even 1 week, you immediately default and lose the house, even though the house itself is perfectly fine.
That is an extreme but conceptually flawless analogy. The fundamental business model of banking actually relies on a deliberate maturity mismatch.
It's baked into the system.
It is. They take in short-term liabilities, deposits that can be withdrawn at any time, and transform them into long-term assets, like mortgages and corporate loans. This mismatch is profitable because long-term interest rates are typically higher than short-term rates.
So when does it become a crisis?
The danger arises when management gets greedy and pushes that mismatch to the absolute extreme, relying on overnight wholesale funding to buy 30-year bonds. If the yield curve shifts or if the short-term funding market experiences a shock, they are trapped.
They can't get out.
They cannot sell their long-term assets fast enough or without taking catastrophic losses to cover the sudden demands of their short-term creditors.
Didn't we just see this happen?
Yes. This exact mechanism of extreme maturity mismatch is what recently annihilated several high-profile regional banks. The deposit flight happened in hours, and their long-term assets were fundamentally illiquid at the prices they needed.
So that perfectly covers the L in camels. What about the S sensitivity?
Sensitivity evaluates a bank's exposure to broader market risks outside of their direct loan portfolio.
Give me an example.
If interest rates spike by 200 basis points, or if foreign exchange markets experience extreme volatility, how severely does that impact the bank's earnings and economic capital?
I see.
This is particularly critical for large banks with massive trading operations and complex derivative books. And the primary metric used to quantify this market risk is value at risk, or VAR.
The notes mention that VAR is covered much more extensively in the portfolio management readings, but conceptually it just acts as a statistical boundary line, right?
Pretty much.
A bank's risk model might state, we are 95% confident that our trading desk will not lose more than $50 million in a single trading day.
It attempts to put a numerical perimeter around the daily chaos of the markets. However, the critical flaw with VAR, which analysts must always keep in mind, is that it tells you absolutely nothing about the other 5% of the time.
The outliers.
Yes. VAR is based on normal market distributions. It completely fails to predict the magnitude of losses during rare fat tail events or black swan crises. When markets gap down violently, the actual losses can obliterate the VAR estimates entirely.
Wow. So we have thoroughly unpacked the CAMEL's framework: capital, assets, management, earnings, liquidity, sensitivity. It provides a really rigorous, heavily numerical scorecard for evaluating a bank's health.
It's the gold standard.
But here is where the pristine models collide with messy reality. Sometimes a bank's survival depends on factors that do not exist anywhere on a balance sheet.
The intangibles.
Exactly. This brings us to the intangibles: government support and culture. Let's address the most significant market distortion first. Government support, commonly known as the too big to fail doctrine.
Yeah, we have to talk about that.
We established early on that large financial institutions have a massive contagion effect. Because they are so deeply interconnected with the global plumbing, governments are often terrified of the collateral damage a failure would cause.
Right. They can't let them go down.
So they feel compelled to step in, use taxpayer funds, and recapitalize the failing institution to prevent a broader economic depression. The notes explicitly reference the TARP program, the Troubled Asset Relief Program from the 2008 crisis, where the U.S. government injected hundreds of billions of dollars directly into major banks.
Historic intervention.
But doesn't the existence of that implicit safety net completely warp the fundamental analysis? Let's say I run a rigorous CAMEL's analysis on a smaller regional community bank. Their capital ratios are fantastic, their LCR is bulletproof, their management is conservative, they look incredibly safe.
Okay, a model bank.
Then I analyze a massive, globally systemically important bank. Their metrics are weaker, their maturity mismatch is aggressive, and their derivative book is just a black box of level 3 assets.
Sounds risky.
Despite the data, isn't the giant, weaker bank actually safer for a bond investor simply because the market knows Uncle Sam will never allow it to default?
You have just articulated the exact definition of moral hazard.
It's crazy.
Yes, it warps the analysis profoundly. Bond investors often demand lower yields, meaning they accept less compensation for risk when buying debt from globally systemic banks, precisely because they are pricing in that implicit government guarantee.
So the market is essentially subsidizing their bad behavior.
The market subsidizes the risk-taking of massive banks because the downside is backstopped by the state. Interestingly, the notes highlight a really counterintuitive dynamic regarding this implicit support.
What's that?
It is inversely related to the overall health of the broader economy.
Wait, I would assume the opposite. Why is the support inverse to the economy's health?
Consider the political and economic calculus of a regulator, okay? If the overall economy is booming, unemployment is low, and the rest of the banking sector is highly capitalized, the system is robust.
Right, everyone's happy.
If one isolated, reckless bank gets into trouble during a boom, regulators are much more likely to let it fail and be liquidated. They want to set an example and reestablish market discipline, knowing the broader system can absorb the localized shock.
Okay, that makes sense. But what if things are bad?
If the entire global economy is already in a severe recession, credit is tight, and market confidence is hanging by a thread, the regulator's calculus totally flips. In a fragile environment, they are terrified that even a medium-sized failure could trigger a cascading panic.
So they rush in to save them.
Therefore, paradoxically, a bank is much more likely to receive government intervention during a terrible economic climate than during a good one.
That is a fascinating psychological overlay to the numerical analysis. The worse the macro environment gets, the wider the safety net is deployed.
Exactly.
Another intangible the text focuses on is corporate culture. But how does an analyst quantitatively measure culture? You can't just read the bank's promotional brochures.
No, you definitely can't do that. You measure culture by observing how management handles the gray areas of accounting and risk.
Like the loan loss provisions we talked about.
Exactly like that. If a bank is consistently slow to recognize deteriorating economic conditions, keeping their loss reserves artificially low just to juice current earnings, that is a glaring cultural red flag.
It shows where their priorities are.
It indicates a culture that prioritizes short-term executive compensation and stock price appearance over long-term prudence and transparency. You also look at their history of regulatory fines and whether they frequently have to restate their historical financial results.
The notes also delve into the specific cultural mission of community banks.
Hmm.
We tend to view local community banks as inherently conservative and safe compared to Wall Street behemoths.
Usually, yeah.
But the text says their very mission statement can be a massive risk factor.
It really can. Community banks exist to serve and promote their specific local geography. While admirable, it creates immense geographic and sector concentration risks.
I see.
If a local bank in West Texas dedicates 70% of its loan portfolio to the regional oil and gas industry, and the global price of oil collapses, the bank's entire asset base deteriorates simultaneously.
They're trapped in that one sector.
They completely lack the geographic and industry diversification that protects a massive national bank. Their mission is their greatest vulnerability.
Wow. Well, we have thoroughly dissected the banking universe. We've flipped the balance sheet upside down, navigated the peer pressure of Basel III, scored the camel's framework, and evaluated the hidden safety nets.
We've covered a lot of ground.
We really have. But the CFA Level 2 reading covers another massive pillar of the financial system, one that operates on a completely different wavelength.
Yes, it does.
They don't take deposits. They don't worry about 30-day bank runs. They trade purely in the realm of risk and time. Let's pivot to insurance companies.
The insurance business model is elegantly simple in theory, but incredibly complex in execution. At its core, an insurance company generates profit from two distinct streams.
Okay, what are they?
The first is underwriting income. They aim to collect more money in premium payments from their policyholders than they pay out in actual claims and administrative expenses.
Makes sense. That's the basic business.
Right. But the second, and arguably more powerful stream, is investment income generated by the float.
The float. This is the concept Warren Buffett famously used to build the Berkshire Hathaway empire.
The very same.
How exactly does it work?
When you pay your auto insurance premium in January, the insurance company doesn't put your money in a vault and wait for you to crash your car.
I would hope not.
Right. You might not file a claim for 5 years, or you might never file one. In the interim, the insurance company takes your premium and the premiums of millions of others and invests that massive pool of capital in the financial markets to generate a return.
Oh.
That pool of invested money is the float. The insurance company is essentially getting paid by its customers to hold and invest a massive revolving pool of capital.
That is an amazing business model. But to analyze these companies effectively, the text dictates that we must split the industry strictly in half. The ratios and risks depend entirely on what kind of insurance they are writing.
It's completely bifurcated.
We have property and casualty, or P&C insurers, and we have life and health, or L&H insurers. Why is the divide so rigid?
Because the fundamental nature of the risks they underwrite dictates their entire liquidity profile and investment strategy.
Okay, let's look at property and casualty first.
So P&C covers physical assets and liabilities, auto insurance, homeowners insurance, commercial property insurance. The defining characteristic of P&C claims is that they are lumpy and highly unpredictable.
Right. A hurricane doesn't care about a quarterly earnings schedule. A massive wildfire doesn't consult an actuary before it ignites.
Exactly. A P&C insurer can go months with normal, predictable claim volumes, and then a Category 5 hurricane hits a major coastline, triggering a catastrophic spike in claims that must be paid out immediately to help people rebuild.
So there is zero predictability.
Very little. Because the claims are volatile and can occur at any moment, the duration of P&C contracts is very short, typically 6 months to a year.
Yeah.
More importantly, this volatility creates massive liquidity risk. The P&C insurer cannot lock up their float in 30-year corporate bonds or illiquid real estate projects. Their investment portfolio must remain highly liquid so they can instantly access cash when the hurricane hits.
That makes total sense.
Yeah.
Now contrast that chaotic environment with life and health insurance.
Life insurance operates on completely different mathematical laws. While it is impossible to predict when one specific individual will pass away, if you aggregate millions of policyholders, mortality rates become incredibly statistically predictable.
The law of large numbers.
The law of large numbers takes over. Actuaries can predict with stunning accuracy exactly how much the company will need to pay out in death benefits over the next decade.
So to use an analogy, life insurance is basically a massive, slow-moving, highly predictable math equation playing out over decades.
Yes.
While property and casualty insurance is more like running a casino, where you know the odds, but a hurricane could still hit the roulette wheel and wipe out the house at any random moment.
That captures the dynamic perfectly. And because life insurance claims are predictable, and because the policies often last for 20 or 30 years, L&H insurers have a very long contract duration. Their float is incredibly stable.
So they don't have that same liquidity panic.
Exactly. They have minimal short-term liquidity risk. They can afford to invest their massive float in long-term, high-yielding assets like 30-year corporate bonds or infrastructure projects to maximize their returns.
But there has to be a catch.
There is. This long-tail strategy exposes them heavily to interest rate risk. If they lock their float into bonds yielding 4% and global interest rates suddenly spike to 8%, their investment portfolio suffers a massive drop in valuation.
Ouch. Because P&C is so volatile, analysts use very specific ratios to evaluate their operational efficiency. The notes provide a detailed breakdown of these metrics. Let's start with the foundation, the underwriting loss ratio.
The underwriting loss ratio measures the fundamental quality of the company's core risk pricing decisions. Are they charging enough for the risk they are taking?
Okay, and the formula
The
is?
formula is claims paid plus the change in loss reserves, all divided by net premiums earned.
The change in loss reserves is an interesting variable. Why isn't it just claims actually paid out?
Because of the timing of claims. Imagine a complex commercial liability lawsuit that stems from an accident this year.
Right.
The insurer knows they are going to have to pay, but the litigation might take 3 years to settle. They must estimate that future payout and add it to their loss reserve today.
I see.
If they have to dramatically increase their loss reserves because past accidents were worse than anticipated, it acts as a massive hit to current period earnings. So if an insurer has a loss ratio of 70%, it means 70 cents of every premium dollar they collect is going directly out the door to cover actual claims or to bolster the reserve for incoming claims.
After paying the claims, the company still has to actually keep the lights on, right?
Yeah.
That introduces the expense ratio.
The expense ratio evaluates operational efficiency. It covers the costs of acquiring and servicing the business commissions paid to sales agents, marketing campaigns, underwriting salaries, technology infrastructure.
All the overhead.
Exactly. The formula is underwriting expenses divided by net premiums written. And it's really important to note the denominator here is premiums written, not earned.
Why is that distinction important?
Because the massive acquisition costs, like agent commissions, are incurred the absolute moment the policy is written, regardless of how long the policy lasts.
Got it. And when you sum the loss ratio and the expense ratio together, you arrive at the absolute granddaddy of all insurance metrics, the combined ratio.
The combined ratio is the ultimate test of underwriting profitability. It is total insurance expenses divided by net premiums earned. It tells an analyst in one single number whether the insurer is actually making money from selling insurance before a single dollar of investment income is factored in.
So if an insurer reports a combined ratio of 105%,
It means they are operating at an underwriting loss. They are spending $1.05 for every single dollar of premium they collect.
a normal business operating at a 105% cost structure would quickly spiral into bankruptcy. But in the insurance world, an underwriting loss doesn't necessarily mean the company is dying, does it?
Not necessarily. And again, this goes back to the power of the float.
Right.
If an insurer is losing 5% on their underwriting operations, but they are generating an 8% return by aggressively investing their massive float, the enterprise as a whole is still generating a positive net income.
That is wild.
They are essentially using insurance policies as a slightly expensive way to acquire capital to invest. However, a highly acclaimed top-tier P&C insurer will consistently achieve a combined ratio under 100%, meaning they're getting paid an underwriting profit while simultaneously generating investment income on the float.
The notes mention that the P&C industry is highly cyclical, fluctuating between hard and soft pricing markets. And these cycles are entirely driven by the industry-wide combined ratio. How does that macroeconomic cycle actually function?
It is a perfect illustration of capital chasing yield. Let's say the industry experiences a few quiet years with no major hurricanes or catastrophes. The industry combined ratio drops to an incredibly profitable 90%. This is considered a hard market.
Okay, so they're making lots of money.
Wall Street sees this massive profitability and floods the insurance sector with new capital. New boutique insurers pop up and existing giants expand. To win market share in this crowded space, insurers start cutting their premium prices and loosening their underwriting standards.
They start raising each other to the bottom just to get the premium volume.
Precisely. As they slash prices, the industry combined ratio starts creeping up. It hits 95, then 100. Eventually, a string of natural disasters hits, and the combined ratio spikes to 110%.
So now the whole industry is bleeding cash.
Bleeding cash. Panic sets in. The new capital flees. The surviving insurers aggressively hike their premium rates and refuse to cover high-risk properties to stop the bleeding. The market hardens again, driving the combined ratio back down to profitable levels, and the multi-year cycle just begins anew.
The final nuance the text adds to this is the combined ratio after dividends.
Yes.
Some mutual insurance companies, which are theoretically owned by their policyholders rather than Wall Street shareholders, will actually pay dividends back to their customers if the year is exceptionally profitable and claim volumes are low. To get the absolute final picture of underwriting profitability, an analyst takes the standard combined ratio and adds the ratio of dividends paid out.
It's the most complete picture.
Rather than reading through a dense grid of numbers, let's look at the qualitative insights from the hypothetical comparison in the text between two insurers, IPCO and DLPHI.
It's a really revealing comparison.
If we run the math, IPCO generates a combined ratio after dividends of roughly 78%. DLPHI comes in higher, around 86%. Both are well under the 100% threshold, meaning both are generating fantastic underwriting profits.
Yeah.
But the underlying reasons for their ratios tell completely different stories about how they run their businesses.
Exactly. When you dissect the components, you see that both companies are experiencing very similar claim volumes. Their loss ratios are almost identical. The massive divergence is in their operational efficiency. IPCO's expense ratio is nearly half the size of DLPI's.
That's a huge difference.
It is. This numerical output dictates the analyst's next qualitative step. You have to investigate why IPCO is so much more efficient. Do they bypass expensive human broker networks and sell directly to consumers through a highly automated app? Is DLPHI saddled with legacy technology and bloated corporate overhead?
So the numbers just point you in the right direction.
The ratios tell you where to look, but the analyst still has to figure out how the business actually operates.
Let's step back and look at the massive landscape we've navigated today. We started with the fundamental premise that analyzing financial institutions requires throwing out the standard corporate playbook. We explored the inverted reality of their balance sheets, where customer deposits act as heavy liabilities and paper promises act as volatile assets.
It's an upside-down world.
We decoded the peer pressure enforcement mechanism of the Basel III framework and its mandate for shock-absorbing capital and liquidity.
And we spent significant time unpacking the CAMEL scorecard, which is the foundational tool for any banking analyst.
Yes, we explored how risk-weighted assets dictate capital floors, the existential dangers of level 3 mark-to-model assets.
Mark-to-myth.
Mark-to-myth, exactly. And the vital importance of independent boards in curbing executive risk-taking. We also drew a stark line between the sustainability of net interest income versus the volatility of trading profits.
We covered a lot on liquidity, too.
Consider the two foundational concepts we discussed today: the float in insurance and maturity mismatch in banking. Both of these incredible profit engines rely on a massive, almost invisible assumption about the nature of time.
Oh, that's interesting.
They operate on the fundamental assumption that the future will unfold at a predictable, manageable pace. They assume that depositors will not all panic and demand their cash on the same Tuesday, and that policyholders will not all suffer catastrophic losses in the same week. The entire global financial system is essentially a highly leveraged bet on the steady pacing of time and human behavior.
It really is a bet on human psychology.
It is. The next time you log into your banking app to check your deposit or you pay your monthly insurance premium, ask yourself, are you truly confident in their internal math, their Tier 1 capital buffers, and their mark-to-model valuations? Or are you, like the rest of the market, simply trusting that the grand illusion of stability will hold for one more day? Thank you for joining us for this deep dive.